Peer-to-peer lending is still a relatively new term in the business world, but there appears to be a lot of excitement about it in the blogosphere. However, many financial experts don't really understand the degree of enthusiasm and interest that this investment has generated across the board. But this can be attributed to the frenzy caused by a new investment product. If you've ever invested, you know the risk associated with any return. How much danger, though, is too much? Where do you draw the line? Peer-to-peer lending, often called P2P, enables an individual investor to lend money to consumers. You may make investments on websites like Lending Club and get to partially screen the investor using their credit history. Many have testified to personally investing in this manner and saw some reasonable returns, but not like the outcomes they've had by investing in index funds. Since this judgment is made retrospectively, this fact alone does not prove that stocks are superior to P2P investments. P2P financing is an unsecured loan. You are using the individual's word and credit history as collateral. This alone explains why such private financing efforts have respectable default rates. You need to consider some factors when thinking about P2P lending. Lending to a single individual is comparable to buying a very modest amount of hazardous shares in your biotech or junior mining firms. Since you don't know much about the borrower, your loan to them might be jeopardized if they experience an emergency situation. You may lessen this risk by making loans utilizing a portfolio strategy. But although doing so helps lessen your risk, it doesn't alter the fact that the underlying asset class is still extremely hazardous. A portfolio of peer-to-peer loans is similar to a mutual fund with multiple junior mining businesses. You lessen the likelihood of any firm collapsing, but you aren't shielded from circumstances impacting all junior mining companies, such as declining metal prices. Interest rates are one of the major dangers you should be concerned about. People who use peer-to-peer lending are presumably those who are unable to obtain a loan from a bank at a reasonable rate. In most cases, many of these individuals have already reached their credit limit or, at the very least, are heavily indebted, making them particularly vulnerable to an increase in interest rates. The fact that the interest rates are too good to be true is another worry you should have. You can tell a borrower couldn't obtain the same loan from a bank if they are prepared to take your money for 20%. This presents a concern for two reasons. You are not getting a deal. You are getting a high-risk loan since banks are far better at assessing debtor risk. Suppose the individual appears to have fair credit. In that case, they may have used up all their credit limits, suggesting that their credit score is useless in such circumstances. Any default rates are probably underestimated because P2P hasn't been around for that long. Looking at default rates before 3 years won't be particularly realistic because a loan might go delinquent at any point throughout the 3 years. Additionally, do they calculate default rates based on periods or years? If not, any new loans will significantly lower the default rate. A crucial element in the investment process is asset allocation, or the kind of assets you invest in, such as stocks, bonds, or cash. Experts advise that you should put at least 40% of your money in fixed income and at most 60% in stocks. However, lending firms tend to assure you that P2P lending is regarded as fixed income and should fit within your intended asset allocation. But the security here is a concern. There is no assurance of getting your interest on the specified period or even your money back at any point. For fixed income assets, this is an amount you should be assured about, since this is often the fallback plan when stocks fail. Something is probably not genuine if it seems too good to be true. Currently, accounts provide interest rates of about 4%. However, there is a good potential that you might lose 10% or more if you invest in P2P loans with an expected return of 10%, which puts you at significantly higher risk, much like equities. Also, a platform might go bankrupt anytime, just like any other business. This could be caused by a dearth of investors or loans, bad platform management, or excessive credit default rates. Investors risk losing their money if the platform declares bankruptcy in this situation. The risk sharing is quite unilateral. Lending platforms pay their bills first, and then you get your share. The loans are set up such that the platform's charges are greater during the first 2 years of the loan when defaults are more likely to occur. Many platforms are unwilling to bear the risks when loans fail, since they only get a portion for acting as the intermediary. The borrower pays loan origination costs up front to the platforms. The lender only receives P&I on payments instead of a percentage of these fees. When loans default, the fees and expenses fall on you. Similar to the casino, platforms always come out ahead. Peer-to-peer lending is now a high risk for little profit. Therefore, investors should proceed cautiously. Prosper and Lending Club have agreements with significant institutional investors, and everyone involved in the financial industry knows that huge money always has a cost. Everyone else receives theirs after the big investors. The default rate on loans from the small investor pool increased about the same time as institutional investors joined in, despite Prosper's claims that the loan portfolios are completely distinct. Although the ongoing job market deterioration is more likely to blame, as an investor, it can be difficult to share the feeling that the institutional investors are cherry-picking and the rest of us are getting the leftovers. That's all from this video. Have you ever invested in a peer-to-peer platform? If yes, what was the experience like? See you in the next one.